Good morning. This is Jeffrey Christian, CPM Group. Welcome to our 2019 Gold Yearbook. This is the 33rd year in which CPM Group has been producing this report. Prior to 1987, I guess we were producing these reports as Goldman Sachs's Commodities Research Department, and before that, Jay Aaron's Research Department. And that series of gold reports on an annual basis and biannual basis goes back to about 1971. I'm proud to say I was not here doing this in 1971, but I have been responsible for these reports since 1980. So today we're going to be launching our Gold Yearbook and talk about it. As always, we have to thank the sponsors and partners of CPM Group in producing this. We have a series of sponsors, including Goldfields Limited, the scrap recycling industry, Kitco, Monex, Noah Capital Markets in South Africa, and the Sabin Metals group of companies who help underwrite the research that goes into our yearbook on gold. In addition to that, we have three partners in China: the China Gold Association, the China National Gold Corporation, which is the largest gold mining company in China, and Jingyi Gold, which is one of the largest providers of gold investment products and jewelry within China, and a company that's been around since the earliest days of liberalization of the Chinese gold market. Those companies are our partners. They translate the gold and platinum yearbooks into Chinese and distribute them there and host briefings for those reports when they're available in Chinese. So we're happy and proud to have a great deal of longevity with our sponsors as well as our partners. I'm going to be speaking today a little bit about the gold price and the economic environment in which we're operating in and the gold market. Then I will pass the screen over to Rohit Savant. He is our Vice President for Research and Director of Research, and he's the primary author of our gold reports as well as our precious metals reports. The gold price has been trading it's been trading between 1280 and 1350 for the last few months, really since the start of the year. And one of the points I would make is that there are similarities to what we saw in 2018 to what may happen in 2019, but there are critical differences that may emerge that will make 2019 distinct from what 2018 was. If you look at 2018, the gold price had dropped down to about 1240 or so by the end of 2017. It rose and got as high as 1380 in the first quarter of 2018. At the time, there was a great deal of bearishness about the state of the economy, both in the United States and globally. There were concerns that we were moving into a recession, and there was a view that the economic and political environments had a number of problems that were coming home to roost. In addition to that, there was concern about the stability of the financial system globally, top-heavy stock market at the time, as well as concerns about the fragility of the global banking system and major banks. In that environment, investors were buying gold and they drove the price up to 1380. By the time we got to late March, April of last year, a lot of that pessimism had dissipated. And you saw people start to think that the economy in the United States and China, in parts of Europe and other parts of the world, including South Africa, in fact, was much stronger than people had expected. Not only were we not moving into a recession in 2018, but the economic output in the United States was going to be very strong. In that environment, the interest rates were rising, the dollar rose, investors wanted to invest in the U.S. stock market, in U.S. corporations, and in U.S. real estate, and they needed dollars to do that. At the same time, the Fed was unwinding some of its balance sheet, which meant basically that it was sucking dollars out of the global banking system, dollars that were needed by commercial borrowers to service the debt that they had. And so you saw the dollar rise, you saw interest rates rising, and the gold price fell. Now, when we launched our 1218 Gold Yearbook, we were of the opinion that the price, which was around 1360, 1380, would probably drop down to about 1280 over the course of 2018. It did drop to 1280, and then it promptly dropped to 1180. And a little bit lower than that on a spot basis, down to about 1160 something. So we were wrong in expecting the gold price to hold up better. And what we saw, and Rohit will talk more about this, was that we saw a lot of investors move away from investment demand for gold. And investment demand for gold, physical gold, was actually quite weak last year, as well as a large short position that developed on the commodities exchange. And again, Rohit will talk about those things. Over the course of the fourth quarter, people started growing more worrisome about the state of the economy and some of the political issues, and they started buying more gold again. We saw that drive the price of gold higher, and the gold price got up to $1350 in the first quarter of this year. It's now backed off, and it's trading around 1311 the last I looked this morning. So we're looking at this again. Our expectation is that the gold price will probably trade between 1280 and 1330, 1350 over the next couple months. We think the price probably gets a little bit stronger yet in March and April, and then comes off into the second quarter and maybe moves down to 1280. Our expectation is that 1280 may well hold, but there is a head and shoulders pattern that could form on the gold price chart. And given that about 90% of the short-term trades in gold futures, forwards, spots, and options are based on technical analysis, there'll be a lot of trading around 1280, just as there was last year, with the view that if the price of gold does break forcefully below 1280, the next stop in this head and shoulder pattern would be 1210. So there is the scope for the gold price to fall as sharply as it did last year, or almost as sharply as it did last year. This is where the differences come in. We are 12 months down the road. We are seeing a strong economy in the United States. Part of the reason why this gold price has risen earlier this year in the first quarter has been that people were concerned about a recession in the United States. They were concerned about growth in the United States. We had the government shut down for an extended period of time. GDP will be very low in the first quarter. It probably will pick up in the second and third quarters. Our expectation is that US GDP goes from 2.8% last year to about 2.4%. Some other people are looking at 2% GDP for this year, which is still a very strong level. We're not going into a recession this year in the United States. In China, people are concerned about the state of the economy. GDP is likely to go from 6.6% last year to about 6.2%. And on a global basis, GDP is probably going to drop 0.2% or so, but still remain relatively strong. We are seeing signs that the current economic expansion, which dates back to 2009, is getting long in the tooth. We are moving toward full employment in the United States, although there are still some very strong structural weaknesses in the employment environment. But we don't think that we're going to go into a recession. So we think that as the second and third quarters go, investors may back away from gold a little bit and the price could come down. And then possibly as the fourth quarter emerges, people will become more concerned about the state of the US and global economies once more, and gold could rise. So that's our expectation on the price of gold. And here you can see the underlying economic environment. We see some weakness in the advanced economies, the developing economies in the United States and Europe. Brexit is obviously a problem that is now staring Britain in the face as opposed to being 12 months down the road a year ago. We see emerging economies actually rising a little bit this year, even in the face of weaker growth in China. And we see a global economy basically moving sideways. So that's our economic outlook and what we think were the implications for prices. Before I hand over the screen to Rohit, I want to show you this chart. In November, the London banking industry started reporting trading volumes. The London over-the-counter gold, silver, platinum, palladium markets have been extremely opaque for centuries. In 1997, the London banks started publishing clearing volumes on a monthly basis to show the clearing volumes of gold and silver. And then in November of last year, they started showing trading volumes. The clearing volumes were about 18 to 21 million ounces a day. The London banking industry suggested that the trading volumes might be 4 times that. They did that in the late '80s when they were trying to convince the Bank for International Settlements that gold was a liquid enough market to be considered a tier 1 asset in calculating liquidity ratios. The BIS said no and disallowed the idea of making gold a tier 1 asset for commercial banks. If you look at the data that has come out since November, you can see the blue chart, the blue bars here, that we've been running between 100 and 150, 160 million ounces of gold trading per week. That includes spot trades, which have been 50 to 60% of the volume, 70% late last year, 50 to 60% since the beginning of January. And it also includes swaps, which are the forward transactions, which are the bulk of the other trades. And then as well, it includes options and gold leasing positions. So if you look at it on a total trading volume, and you're talking about 150, 160 million ounces a week, you're talking about 20 million, 40 million ounces. You're talking about 1.5 times as much trading volume as you have clearing volume. And in fact, the ratio has been between 1 and 2 in terms of the ratio of trading volume on the spot basis relative to the clearing volumes. It's interesting that the data's come out. It shows that the gold market is somewhat less liquid in the OTC market than a lot of people had thought it was and said it was. While the view was that perhaps as much as 4 times as much was trading as was cleared, there were people in the gold market, commentators, who were suggesting that it was much higher. It's clearly not that much higher. It's very good for the gold industry and the gold market to have this kind of increased transparency in data. It's the early days of the data, and we still have a lot more to calculate and review this and see what's going on here. But it is good that this has occurred and that we're starting to see this data. Now, I'm going to pass the screen over to Rohit at this point, if I can do that. And I will let him take over the presentation from this point. So Rohit, you there? Go for it.
Yes. Thank you, Jeff. So I'm going to start here by speaking about investment demand for gold. But before I get into the specific statistics of gold investment demand, I just wanted to go through a couple of slides that are related to our thinking regarding investment demand. So what you're looking at here is the long-term historical gold price on a real and nominal basis, basis 2018. And as we can see, gold prices have come off sharply since they reached a record high 1670 in 2012 on an annual average basis. And since around 2014 through 2018, we've seen prices average about 1240. So that's about a 25% decline in prices, and that is a meaningful decline. But when you look back at gold prices longer term, both on a real as well as nominal basis, the level for prices that we have right now are still extremely high. And the reason for that is there are a lot of risks in the global economy, political risks, economic risks. However, while there are a lot of risks in the economy, most of these risks at the moment are what we would consider moderate probability risks. So just to explain a little bit about what this chart is showing, we've put here a lot of the risks that we see that we think would influence gold and gold investment demand. And what the chart does is it ranks these risks from low to high on the probability of them materializing and what sort of impact they're likely to have on the price of gold. Again, we rank that from low to high. So without, and the colors, what you're looking at here is the green is basically risks which would typically be positive for the price of gold. Red would be negative, and then you have some yellows in there which have the potential to start off as being positive and then turning negative, or vice versa. So without getting into the specifics of each of these risks, I'd just like to talk about the key takeaways here. And what you're seeing is a lot of these risks are clustered in the lower right-hand side corner of this chart. So what that tells us is that you have extremely high impact risks. That is, if these risks do materialize, they would have a meaningful impact on the price of gold, whether positive or negative. But they also are low to moderate probability risks. So risks that we think have only a moderate probability of materializing in the short to medium term. And this helps to explain to a large extent why we've seen gold prices do what they've been doing over the past few years, which is they've kind of moved sideways at elevated levels, but we haven't really seen them shoot up strongly. So you have all these risks supporting prices from declining, but you don't really see them necessarily materializing, which is preventing them from rising sharply. Another thing that we're seeing in this chart is a lot of the risks are green. So what that says is that when these risks do in fact materialize, they're probably going to be positive for gold versus being something that a risk that would be negative for gold. Also, what's not apparent in this chart is that a lot of these risks are driven by political factors. We think that political risk is probably one of the most important risks that you're seeing in the global economy today, and has the potential to basically derail economic growth going forward. And another thing that has been happening in the gold market is that you've had loose monetary policy, you've had late stage fiscal stimulus, and so all of these, this loose policy in general has to a great extent masked some of these risks. It's allowed investors to a great extent ignore these risks. They know they exist, but they haven't been paying keen attention to it, and they've been involved in buying more risk assets. But what that's doing is it's allowing these structural long-term risks to grow larger. And at some point, when the global economy begins to slow in a strong or meaningful way, these risks we think will materialize. And at that time, we would expect gold prices to rise sharply. So our thinking with regards to gold prices in the medium term is that we do see gold prices trending higher, but we don't see them shooting up strongly, at least for the next 3 to 5 years, for example. This is our base case scenario. We don't anticipate a very sharp decline in gold prices from current levels either, because of the existence of all these risks. And then in an alternative scenario, if things get bad economically sooner than we expect, and one of these risks or many of these risks materialize and move to the, say, the right-hand side, the top right-hand side corner of this chart, you probably see gold prices shoot up sooner and could potentially even go past the levels that we've seen in the last boom in gold prices. So we do, I guess what's common between the two scenarios is that we don't anticipate a lot of downside risk. We do think gold prices move up and they move up sharply. It's a matter of timing whether they move up sharply over the next couple of years or whether it's a 3 to 5 year period. So that I'll move on to the gold investment demand statistics. We saw that gold investment demand's been net positive. So this is the net additions to gold investor holdings, and we've seen investors continue to buy gold. They bought less gold last year than they've bought in the recent past. They bought about we estimate about 12 million ounces on a net basis. And this was to some extent expected. You had a relatively healthy global economy for most part of last year. You had extremely strong stock markets for most part of last year. And so investors were distracted with that and were somewhat ignoring buying up gold. So that kind of weighed on gold investment demand last year. We think that would reverse to a certain extent this year. We expect gold investment demand to rise to about 17 million ounces, which is positive for gold. But again, both these levels, while they're positive enough to provide downside support to gold. They're not strong enough levels of gold investment demand to lead to a strong move up in gold prices. For gold prices to move up strongly, what we've seen is that typically when they tend to move higher than 20 million ounces, this is just an observation. There's no way to say whether if it moves over 20 million ounces, it's guaranteed to push gold prices higher. But we've typically seen that when investors have bought in excess of 20 million ounces, it has resulted in gold prices moving up more sharply. So we don't necessarily see that happening this year, but we do see gold prices being supported on the downside. What this chart is showing you is real interest rates and their relation to gold returns. And it's pretty clear that unless you get to real interest rates that are in excess of 2%, you're not necessarily going to see a lot of negativity from interest rates on gold prices. Right now, the 3-month treasury is at about 0.85 on a real basis. So we're somewhere between 0 and 1, which is still in positive territory. So real interest rates at these levels typically do not have a negative impact on gold prices. And we don't necessarily see real interest rates getting to 3% anytime soon. We don't anticipate an increase in interest rates in the US unless you see an uptick in inflation, which in itself will contain the real interest rate. So we don't necessarily see real interest rates being particularly negative to gold anytime soon. This chart's showing you the US dollar versus on a trade weighted basis. And again, our view on the dollar is that we think it continues to move in a sideways, volatile fashion at current levels. We're not in the camp that believes that the dollar is going to decline. There are headwinds to the dollar. Obviously, the Fed is uh, pausing its monetary tightening, so that will have somewhat of or provide somewhat of a headwind to the US dollar. But when you look at other major economies, they're in much worse shape than the US is, which then results in providing downside support to the dollar. So we don't see the dollar moving up sharply from where it is right now, but we don't necessarily see it declining either. So kind of sideways at current levels. Um, so this is ETF investors, and ETF investors have been net buyers of gold over the past 3 years. Between 2016 and 2018, they bought up about 26 million ounces of gold. The net additions to gold investor holdings in ETFs have been declining since 2016. Um, and they have basically bought back about 70% of the gold that was liquidated between 2013 and 2015. So we are seeing, some positivity from this uh, investment vehicle, but it's not been very strong demand. There has been demand. It's just not been very strong demand from this source. And that's somewhat the trend that we've been seeing from other sources of investment as well. So for example, if you look at the chart on the left-hand side, that shows you global coin demand, and it was slightly weaker last year than it was in 2017. It's a lot weaker than it was between 2008 and 2013. Um, and that's because what you're seeing with these coin buyers, who are typically long-term retail buyers, they are aware of all the problems that you're seeing in the global economy. They are interested in adding gold to their portfolio, uh, but they are also extremely price sensitive. So what you've typically seen is that these buyers have tended to come into the market and buy whenever prices have softened, and then when prices have tended to go up, they've retracted. So the impact they've had on prices is again to provide downside support, but not done much to propel prices higher. The chart on the right hand side shows you the net positions of institutional investors on the COMEX. And in 2018, for the first time since 2001, you saw net positions actually move into becoming net short. And that was primarily a result of a sharp or a record buildup in gross short positions. You did not see a meaningful decline in gross long positions last year, which tells you that a lot of these investors did not want to necessarily sell or get out of their long positions, but instead wanted to hedge those long positions by taking on short positions for that short period of time and to take advantage of the decline in prices. So with that, we move on to central banks. Central banks have played an extremely important role in supporting gold prices in the past few years. They bought up a large amount of gold, about 16.2 million ounces of gold last year, which helped to offset some of the weakness in investment demand. Central banks, we expect them to continue being net buyers. This year, we expect that they'd probably buy a little less than they did in 2018. We're forecasting about 14.5 million ounces of gold being bought by central banks on a net basis. The central banks have been buying primarily as a way to diversify away from the US dollar, the euro, and to kind of create a diversification in their portfolio. So we expect this trend to continue. That said, central banks have typically tended to be also fairly price sensitive. So similar to coin buyers, they also tend to pull back or not buy when gold prices tend to go up, and tend to step in as aggressive buyers when prices tend to soften. So we saw this last year in 2018 when um, in the second half of the year, when gold prices had softened, you saw a significant increase in the amount of gold that central banks were buying. Um, this chart shows you that somewhat inverse relation. You have a negative correlation of about 0.52. Obviously, this is just one of the factors that influences central bank buying, but it is something that plays an important role in how some central banks would be purchasing gold. Another thing that we saw last year was the re-emergence of China as a buyer. And if, like Russia and Kazakhstan and Turkey, they step up and go back to buying gold on a regular basis, all of that could be very price supportive for gold in 2019. Moving on then to supply. So total gold supply declined last year by about 1.5% from 2017 to around 126 million ounces. That weakness was primarily driven by mine supply, which slipped to about 95.8 million ounces from around 97.6 million ounces in 2017. And a lot of that weakness in mine supply was driven by China. China is the largest producer, it continues to be the largest producer of gold. That said, mine supply from China declined by about 800,000 ounces in 2018, which was the second consecutive year of reduced mine supply from China, when in 2017 they reduced it by about 1.2 million ounces. And a lot of that reduction has to do with the shuttering of mines where they're not producing gold in an environmentally friendly way. So the closing down of those mines has weighed on Chinese gold mine supply. We think that a lot of that shutting down is already behind us, and a lot of the major producers have been developing technology which is cleaner for the environment, and you are seeing some uptick in gold demand from those producers. So going forward, we think that from China, you don't necessarily see the kind of declines that we've seen over the past couple of years. In 2019, we expect total gold supply to rise. We expect both scrap supply as well as mine supply to both increase this year. Scrap supply has actually been up during both years. A lot of that has to do with the strength in the dollar versus the currencies of countries where gold is consumed in large quantities. So, for example, in India, you had the Indian rupee fall to a record low versus the US dollar last year. And so that tends to boost the price of gold in India and does tend to a certain extent encourage scrap recovery. So we expect that trend to sort of continue into this year as well. So this chart just shows you total global mine supply. Like I said before, we anticipate that you see a slight increase in total mine supply this year. But going forward, we think over the next couple of years, you're going to start seeing total mine supply decline. We do think that total mine supply would decline potentially from 2021, and that decline could last for about maybe 4 or 5 years. And that really is a result of reduced investment in new projects, reduced investment in expansion of projects in that 2013 to 2017 period. You really did see some increases in expenditure in late 2017 and into 2018, but it's not a lot of expenditure, and even for that expenditure to show up in total supply, it would take several years. So we are likely to see a bit of a decline in total mine supply in the next couple of years. So coming back to the near term and what's been happening in the recent past, one of the factors that has been supportive of mine supply has been the weakness in currencies of countries where gold is produced versus the US dollar. And so this has helped to subsidize the cost of a lot of the mining companies. And as you can see in some of these countries, so this is the values of these currencies at the end of 2018 indexed to the middle of 2014, when the US monetary policy began to change from loosening to tightening. And what you've seen is that a lot of these currencies have lost a lot of value over that period, but that has been something that is supportive of gold mine supply in these countries. And when you look at the value of gold over that same period, it's off about 3%. So it's not a very strong decline. And so that actually supports mine supply even further in these countries, because you have a product which hasn't lost that much value. You have costs which are subsidized because of the strength in the dollar. So it's worked out well for mining companies in these countries. Another factor that has helped to support mine supply has been the large amount of capacity that came on stream over the past several years. So between 2011 and 2018, on average, you had about 1.5 million ounces of new capacity that came on stream. And this has helped to boost mine supply, and we think that it'll continue to support mine supply over the next couple of years. But as you can see, going forward, the amount of new capacity coming on stream is shrinking, and it's shrinking pretty fast. So that's expected to start weighing on total supply in that medium to long term period, when older mines, the loss in output from older mines is not going to be offset by this new capacity that's coming on stream. So all-in sustaining costs have been rising, and they have been rising primarily as a result of an increase in cash costs. Cash costs typically tend to have a positive correlation with the price of the metal, and since the first quarter of 2017 through the second quarter of 2018, you generally had gold prices moving higher, and that showed up in cash costs. You had cash costs in the second quarter of 2018 reaching an average of about $704 an ounce, which was the highest level that it was at since the first quarter of 2014. So that increase in cash costs has been the primary driver of an increase in all-in sustaining costs. You did not see sustaining costs, which are made up of costs like G&A and exploration costs. You did not necessarily see that increase. In fact, during 2018, you saw a bit of a pullback in those costs. And again, that supports the view that in the medium to long term, you're going to see a negative impact from this reduced expenditure on exploration as well as expansion of projects. So in fabrication demand, you had fabrication demand rise a little bit last year. It was at about 98 million ounces. There were various factors that helped support fabrication demand during the year. One was a generally healthy global economy for most part of last year. So that boosts discretionary spending. You had gold prices that were not particularly strong. You had gold price volatility that was not particularly strong. So both those factors were helpful to gold jewelry demand. And then you also have technologies being developed, especially in China, where efforts are being made to work with technology and build jewelry which would be more appealing to younger consumers. So they have what they call K gold, and they have 3D gold, which allows for creating more intricate designs uh, creating hollow designs in gold jewelry, which kind of reduces the cost of the jewelry. So all kind of factors that were somewhat helpful in attracting younger consumers to gold jewelry in China especially. Um, so as mentioned before, the strength in the US dollar now has an opposite impact, obviously, in the case of fabrication demand. And so what we can see here is that there's been a general strengthening, especially in 2018, in the dollar versus all of these currencies where gold is consumed in a large way. And that was obviously a headwind to fabrication demand, which explains the relatively small growth in total fabrication demand during 2018, despite a lot of other positive factors. And then this is specific only to India, where in 2018 you had an unusually fewer number of auspicious days for marriage. And so that kind of, to an extent, weighed on gold fabrication demand in India. But that's going to be clearly offset in 2019, where you have an above trend number of days, auspicious days for marriage. So that should help with gold fabrication demand in India during 2019. So that's all we have for the slides, and we can open it up for questions.
Yeah, thank you, Rohit. A couple housekeeping things I didn't mention at the beginning. First off, yes, we'll open it up for questions now. On your webinar panel, you'll see an area for questions where you can type in questions, and then we can read them and answer them. In addition to that, the briefing that you just listened to with this presentation will be reviewable. We will be posting it in a third-party site, and there'll be an information about where that link is that'll be sent out to people. And the report, the Gold Yearbook, is available for purchase now. We produce it as an ebook the last few years as opposed to a printed book, and it is available for purchase from CPM Group as well for $160. So with that, if there are any questions, please type them in and we will respond. This seems to be a question that I can't quite read on my screen. Any thoughts on gold blockchain platforms and if they will have any material impact on the industry in 2019? Take away demand from other gold investment areas. So that was one question. My view is that most investors in gold are tangible investors, and cryptocurrencies and crypto gold are the antithesis of tangible assets. So I think that you might have some people who will dabble in blockchain gold, but I don't think that it's going to be a significant factor distracting people from physical gold. And insofar as some of the blockchain gold initiatives that you see relate to trying to have a more secure distribution channel for physical gold, I don't think that that will be there. There's a second question on the current status of Chinese government restrictions on gold imports for banks. A few years back, it seemed to have slowed down gold imports. China right now is wrestling with a variety of economic factors. some of which relate to the U.S.-Chinese trade arguments that are going on. And I think that those will continue to cause the Chinese government to be extremely conservative about further liberalization of its gold import and export restrictions at this point. There's another question, which is the gold-silver ratio is around 85. Where are you expecting the ratio to trend this year and next year? Rohit, you want to take that one?
Sure. Our expectation for that ratio. So we've seen that ratio has definitely increased pretty substantially over the past year. We don't necessarily see that ratio declining sharply in the short term. That issue has more to do with silver, where silver investors seem to have pulled back even more strongly than gold investors. And that's really what's keeping that ratio at those elevated levels. We do think that if those risks that we talked about earlier in this presentation do materialize, you might start seeing silver investors come back more strongly. And once that starts happening, you're likely to see that ratio come down. But we don't anticipate that happening in the short term. That's again something that we think will happen over the next 2 or 3 years.
Okay. Another question about Chinese imports. What is the current status of import restrictions? And does it seem to us that mainland Chinese gold imports have stalled out over the last couple of years? Rohit, I answered it sort of already. Do you want to answer it too?
No, I mean, I don't think there's anything more I could add to your answer.
Right. Yeah. The reality is that the Chinese gold market leadership is concerned about the strong demand for gold relative to the supply of newly refined gold coming from domestic ores, imported concentrates, and also the scrap in the industry. So they're looking at a gold market in China that is restrictive of more materials than they have supply for. So they're going to continue to want to import gold. Next question is, how much demand is created by electronics manufacturing? Ro, do you want to deal with that?
Sure. So electronics is about it's about 10 to 12% of total demand. Actually, it's less than that. It's about 10% of total demand, electronics.
Ro, your screen, by the way, is visible to everyone. So, yeah, if you want to look at that other stuff, you might want to pass your screen back to me or something.
Okay.
Okay. All right. So were you done with that?
It's about 10%.
Okay. The next question, any more statistical details related to gold usage in jewelry in comparison to technological usage? Do you want to address that, Ro, at least initially?
Is the question about how much jewelry is, how much jewelry
I can address it because I addressed it in this morning's meeting. You know, if you look at the gold market, about 85% of gold demand is for fabrication use, which is jewelry, electronics, dental, and a variety of other applications. The other 15% is investment demand and central bank demand. Of the 85% of gold demand that is fabrication demand, 85% of that is jewelry. And of that jewelry, about 54% of it, or I think another 85%, if I remember correctly, is actually in Asia. And of that Asian demand, or the total jewelry demand, or total fabrication demand, India and China account for about 54%. So in electronics and other industrial uses, such as dental and medical applications, are about 15% of fabrication demand, and jewelry is about 85% of it. I think those are the correct numbers, yes?
Yes.
Okay, any other questions? Okay, I think we'll see if there are any more questions that pop up as we wrap up, but I think that sort of concludes our presentation. One of the key points that we saw last year, as Rohit said, was that investors did back away from buying as much gold as they have for many years. They bought down, their net purchases of physical gold fell to 12 million ounces. And that was really the factor that took gold prices from 1384 in the first quarter of last year down to 1180. And when the price of gold fell, central banks came in. As Rohit showed, central banks are much more price sensitive than private investors, and they have an appetite for gold. That appetite is not going away. It's fed by a variety of economic and political and financial issues, but they are price sensitive compared to private investors. They won't chase the price higher. They won't push the price higher. But if investors don't want as much gold as they did in a prior year, central banks will gladly step in and take the stuff on a discounted basis. Again, we will be sharing the presentation. It will be posted shortly after this is concluded, and we'll send out a notice as to where the link is. If there are no further questions, we'll thank you all for attending, and we'll say goodbye until next month when we launch our Silver Yearbook. Any other questions? Okay, in that case, no. Thank you and good day.